All right, I think we're going to get started here. Good. Thank you everyone for coming today. My name is Sarah Frick. I'm the moderator for today's presentation. Welcome to UWM's How to Obtain a Mortgage class. Today's presentation is intended to help first-time homebuyers gain a basic understanding of the mortgage process. During our class, everyone will be muted. However, we welcome general questions. If at any time you think of a question, type it into the chat and we will answer questions at the end of the presentation. I would like to introduce our two presenters today. First, we have Keister Murdoch. When she was growing up, she wanted to be a teacher. So she found the right career path as an instructional designer at UWM. And next we have Jordan Kinney. Jordan is a Mortgage 101 trainer at UWM. He gets up and presents mortgage knowledge every day. Presenting isn't new to him. In fact, he once gave a TEDx talk at the University of Michigan. Keisha is going to start us off today, so I will let her take it away. Keisha, you're actually muted, so you might want to start back over and unmute yourself, please.
I do apologize for that, guys. Thank you, Sarah, so much. Good evening, everyone. And thank you for taking time out of your day to join us. So today we're going to go through a lot of information. It's going to be truly helpful for your first-time home buying process. And some of the things you're going to learn is knowing your numbers, putting your team together, how to obtain a mortgage, and then your new home. And as Sarah, she's already stated, we do welcome general questions at any time. And if you think of something, please type it into the chat and we will make sure to answer your questions at the end of this presentation. All righty, so let's talk about what is affordable. And you're probably thinking, so who decides what is affordable? Well, affordable housing is what an actual household what they can pay for and still have money left over for your necessities like your utilities and of course food and transportation and healthcare. And it depends on the household's actual income. And just so you know, lenders, they will determine the affordability using certain metrics, such as what's called a debt to income ratios. And that's to calculate the amount of money you can borrow. And it's going to comprise of your total monthly debts and your monthly gross income. And that's actually pre-tax income. However, it's ultimately up to you to decide what's affordable. And of course, there are other factors that play into this calculation, and we'll discuss that a little later in the presentation. Some important factors that you want to consider when you want to determine what is actually affordable for you. And when you're determining your actual household budget, it's important that you factor in your monthly income and all of your monthly expenses. And again, we're going to cover how to calculate this, like your debt to income, more in detail later. But do know that the lenders will calculate your debt to income ratio for qualifying purposes, okay? Also, as a home buyer, you'll want to have a certain level of comfort when it comes to understanding your monthly mortgage payments. And if a lender pre-approves you for a certain loan amount, that monthly payment amount, it may into your overall household budget without getting rid of some expenses elsewhere. So just keep that in mind. Also, when you're looking at your household income and regular monthly debts, they may be relatively stable. However, you got to keep in mind, unexpected expenses and unplanned spending, it can happen and it can impact your savings. But whatever you decide, it's important to remember to always keep that in mind. You got to think about those emergencies that may come up. It can be your household repairs, it could be your car repairs, medical expenses. You know, we all know with life, all of that, it can happen and it does happen. We just want you to be prepared for when it does. And a good rule of thumb is to work on having 3 months of payments. That's including your housing payment, monthly debts, and you want to have that in your savings. Why? Because this will actually allow you to cover your mortgage payment in case of an unexpected event that may come up in your life. All right, so now we're going to learn about gathering information that you'll need. When it comes to the home buying process, documentation is a big part, okay? Because in order for the lender to be able to determine what you can afford, you have to provide documentation so that they can work with you to come up with the correct figures that will work for you. And the lenders, they are going to ask you for this documentation, and it's going to be depending on the actual income that you receive. The lenders, what they'll want to know is that you have stable income, and your stable income, it'll allow you to pay your mortgage payments each month. And more than likely, I'm going to say likely, they're actually going to ask for copies of your pay stubs as proof of employment as well. The lenders, they'll want a snapshot of the money coming and going from your bank accounts. And you'll need to show any outstanding loans that you may have. This could include car payments, student loans, additional mortgages, if that's the case, or credit card debt. And just a tidbit of information that you want to keep in mind also, information that does not report on your credit report, such as alimony or child support payments, you'll need to gather statements to document your monthly payments for those as well, if that applies to your personal situation. Lenders, they'll also need to be able to verify residential history. So that'll be requested for like your last 2 years. You'll need to provide this information when filling out your loan application. So it's good to have that on hand when you start the loan application process. And then after you make an offer on a property and you're going to provide an earnest money deposit, this deposit is actually held in an escrow, and that will show your commitment to purchase a home. And you'll need to provide the source in which the funds from your earnest money, where they actually came from. So you'll be asked to provide a PDF of your bank account history, and that'll do the trick. If you receive the money as a gift from a family member or any other way, you may need to provide a letter confirming that the money was actually a gift and who the funds came from. All right, so 2 important things that you want to know, and that's about the front end ratio and the back end ratio. The front end ratio is also known as your housing ratio. The back end ratio is actually called your DTI, and that's debt to income. The front end ratio it's also known as mortgage to income ratio. It's a ratio that indicates what portion of your income is allocated to the mortgage payments. The front end ratio is calculated by dividing your monthly mortgage payment by your gross monthly income. The mortgage payment generally consists of principal, interest, taxes, and mortgage insurance, also known as PITI. Lenders, they use the front end ratio in conjunction with the back end ratio to determine how much to lend. The principal amount you borrow, and you have to pay back interest, okay? Again, the principal is the amount you borrow, and you have to pay it back with interest. For most borrowers, the total monthly payment you send to your mortgage company includes other things such as homeowners insurance and taxes, and those are actually held in an escrow account. Okay, so now we're going to talk a little bit about back end ratio. The back end ratio is calculated by adding together all of your monthly debt payments, and then you're going to divide that sum by your monthly income. And I have an example. Okay, so let's consider a borrower whose monthly income is, let's say, $5,000. So we're going to take $60,000 annually, and you're going to divide that by 12. Okay, and the total monthly debts is going to, let's say, $2,000. The borrower's back-end ratio based on that calculation, it's 40%. Generally, lenders, they do like to see the back-end ratio that does not exceed 36%. But there are some lenders that will make an exception for ratios of up to approximately 50% for borrowers with good credit. Keep in mind your car note, personal loan, student loans, credit cards, child support, and alimony, they're all included in the back-end ratio calculations. But when it comes to daycare, childcare expenses, and like utilities and subscriptions, we love Netflix and Hulu and HBO Max. Those things are not included in the back-end ratio calculations. Okay, I know this is a lot of information. So at this moment, I'm going to turn it back over to Sarah.
Thank you, Keisha. Yes, that was a lot of information. And we will be answering questions at the end. I want to give everyone the opportunity to take 30 seconds or so to post any questions into the chat, and then we're going to move on. Thank you. Okay, so to discuss pre-approvals and pre-qualifications and what you'll need to obtain them, Jordan is going to take over from here.
All right, y'all, let's talk a little bit about the process of getting a mortgage and look at pre-qualification versus pre-approval. We'll also talk about the information that you'll need to gather, putting together your numbers, and reviewing your options. So after you've determined what you can reasonably afford, the next thing you want to do is get pre-approved. As a borrower, it's important to know what a mortgage pre-approval does and doesn't do, as well as how to boost your chances of getting one. Now, you've probably heard the term pre-qualification used the same way as pre-approval, sometimes used interchangeably, but they're actually not the same. With a pre-qualification, all you're doing is stating an overview of your finances, income, and debts to a mortgage lender. The mortgage lender will then give you an estimated loan amount. So a pre-qualification can be useful as an estimate of how much you can afford to spend on a home, but the lender isn't pulling your credit report or verifying any of that financial information, which means a pre-qualification is a helpful starting point to determine what you can afford, but has no weight when you make offers. The takeaway with pre-qualification is that none of the information provided is verified at that point in the process. Because none of that information is verified, there's also no guarantees that you will receive a final approval for that same pre-qualified loan amount. A pre-approval, on the other hand, involves filling out a mortgage application, which you may hear referred to as the 1003 during this process, as well as providing your social security number so a lender can do a credit check. During this process, a lender will pull your credit report and get your credit score. That'll allow them to assess your borrowing history and financial character before they decide to lend you money. Also, during a pre-approval, you'll have to list all of your bank account information, any assets, debts, employment, past addresses, and other critical details for a lender to verify. The reason for this is the lender has to assess if you can pay back the loan. Mortgage pre-approval letters are also typically only valid for a limited number of days. The lender will put an expiration date on these letters because your finances and credit profile could change. If a pre-approval does expire, you will have to fill out a new mortgage application and submit updated paperwork to get another one. It's important to remember that while you are filling out an application and getting credit pulled, it still does not guarantee a final approval for the loan. So how do you get a pre-approval letter? Well, you'll need to talk to a mortgage originator of your choice. They will be a key part of the home buying process. This person will help you navigate the application and collect and verify any financial documentation. From this information, they can determine if a borrower is qualified for a loan from the standpoint of creditworthiness, your income, and your assets. When choosing a mortgage originator, you will also want to know the difference between retail mortgage lenders and wholesale lenders who work with mortgage brokers. Retail lenders handle the loan in-house and will work directly with prospective home buyers to complete that transaction. They also only offer products available from their own institution. Wholesale lenders are different. They don't work directly with home buyers. Instead, they offer their home loans through third-party clients, which would be mortgage brokers. The brokers then shop around to find the best mortgage rates and terms that align with their borrower's goals. The wholesale lender would then underwrite and fund the loan. If that seems a little hard to understand, we can put it into terms that everyone's familiar with. Think shopping for a new pair of shoes. If you go into a Nike store, that would be like retail lending. If you go in there looking for a pair of shoes, they're going to give you a pair of Nike shoes. They give you a pair of shoes that they have. A wholesale lender and working with a broker would kind of be like going to an independent shoe store where there's multiple brands and that person will work with you to find the best one for your options. All right, so we also want to talk about gathering that information now. When we talk about pre-approval, let's see what you need to have. In order to get your pre-approval, you'll need to put together documents that verify all the information. The more organized and prepared you are for this process, the smoother experience you will have. The required documentation may include 30 days of pay stubs, so regardless of your pay schedule, try to have 30 days of pay, as well as all federal tax returns and W-2s for the last 2 years. If you happen to be a self-employed borrower, you will have additional documentation that you have to provide. Those will include business tax returns, including all schedules. Specifically, the K-1 will show ownership percentage in a business, as well as profit and loss statements to show the stability of the business income being used. And again, that's only for self-employed borrowers. Now, with incomes or documents pertaining to your income, you will also need documentation showing necessary assets to cover down payments and closing costs. When we talk about assets for the purpose of closing costs and down payments, we want to specify that we're talking about liquid assets. Liquid assets are assets that can easily be converted into cash. So liquid assets include things like your checking and savings account, money markets, CDs, or readily tradable stocks and bonds. Liquid assets can also include gift funds that you receive from relatives or other eligible sources to help you on the purchase of your home. It's important to know that regardless of what assets you use, they must be verified and show where it comes from. Lenders have to make sure that all assets are really yours and that they're traceable. This means if you have large amounts of cash deposits going into a checkings or savings account and that source can't be traced, your lender might ask some questions and you might not be able to use those assets because they're unverifiable. One common thing we see is what's called mattress money. So let's say I take $100 every paycheck and I put that into a jar at home or literally put that under my mattress. If I finally save up $10,000 and then I go to my bank to deposit it, I can't just tell my lender, well, I saved that money up over several years and finally decided it was time. That money can't be verified. There's no proof on where that money came from. Gift funds have to be verified as well by providing the mortgage lender a gift letter and a paper trail to prove where it all came from. This accompanying paper trail should include a copy of the donor's withdrawal, borrower's deposit slips, or a copy of the check, something similar. In order to verify your liquid assets, lenders will also usually need 30 to 60 days of bank statements or other monthly, quarterly, or annual account statements. Think retirement savings, stocks, bonds, mutual funds, etc. Buying a home is the biggest financial transaction most people will make. To help you prepare for it, it's important to know these mortgage numbers. So what are some other tips while gathering documents? Make sure you know your credit score and your DTI. Big tip, know your credit score and your DTI. Your credit score helps lenders evaluate your ability to repay your loan based on your borrowing history. And generally, the higher your credit score, the better rates you'll be able to get. Secondly, you want to calculate your DTI or debt to income that Keisha was talking about earlier. Your DTI is a ratio that divides your monthly debt by your monthly income. While your mortgage originator will help you calculate this, you can also do it on your own to provide yourself with an overview of your finances. If you want to do that, just add up all your monthly debts, divide that by your monthly income, and that percentage is your DTI. But see your mortgage originator for the most accurate number. And with that, I'll turn it back over.
Awesome. Thank you, Jordan. As I said before, we'll be answering questions at the end, but please take a few seconds to post questions into the chat. Okay, thank you. Keisha is going to lead things off by discussing our next steps in the process.
All right. Thank you so much, Sarah. Well, guys, now that we know a little bit more about the pre-approval process, it's finally time to talk about finding your new home. And as you're probably aware of, this is the most exciting part of this journey. All right, once you've been pre-approved, you'll want to start looking for a house that's affordable and that fits your personal needs as well as your budget. And this is where the realtors come in. I'm a real estate agent. They'll actually help you locate homes that meets your needs in the price range that you're looking for. Then they'll meet you at the homes. They'll actually come out and they'll walk with you through those homes so you can look at them and to determine if that's the home that you're looking for. And actually, once you have chosen a home to buy, these professionals, they're actually going to assist you in negotiating the entire purchase process. This includes making the offer, getting a loan, and then completing the paperwork. Your real estate agent, they're actually going to help you decide how much money you want to offer for the house, along with any conditions that you want to ask for up front. Your agent will then present the offer to the seller's agent. The seller's agent, they can either accept the offer or they may even issue a counter offer. You can either accept or continue to go back and forth until you reach the deal or decide to call it quits. If and when you do reach an agreement, you'll make a good faith deposit. And then that process transition, it'll actually turn into an escrow. What is an escrow? So escrow is a short period of time during which the seller takes that home off the market with the expectation that you're actually going to buy it, provided you don't find any serious problems when you inspect the home. And along those lines, there are a couple of common contingencies that you will see when it comes to the purchase agreement. So what are the purchase agreement contingencies? In short, the purchase agreement contingencies are conditions or actions that must be met for a real estate contract to become binding. Okay, a contingency becomes part of the binding sale contract when the buyer and the seller agree to the terms and then they sign the contract. So what is a purchase agreement? A purchase agreement, it's also known as a purchase and sale agreement, and it's a legally binding contract, and it's going to outline the conditions that both the buyers and the sellers, they must abide by, and they must abide by, like I said, or complete for the sale of real property by a selected closing date. A proper purchase agreement is going to show some relevant information to the deal. It's going to show, or it's going to list the buyers and the seller's information, the price of the property, and the terms in which the sale is contingent. Okay. And just keep in mind that all contracts must be clearly written to prevent any misunderstandings relating to anything that's going to show on this purchase agreement contingencies. And for example, the terms of the purchase or the concessions. Okay, so you have to make sure that you're avoiding all misunderstandings. And that's why we need to have a purchase agreement so all parties involved are on the same page. And each purchase agreement, it's a custom document that depends on your individual situation. Your agent, they'll typically assist you with completing the agreement along with its details, and they'll discuss any protections that you may need. So you'll get a better understanding of what you're reading, what you're looking at on that purchase agreement. Okay, and also when it comes to the purchase agreement, it will be contingent on your lender's final approval of the actual loan. So let's say now you found your home, you've been pre-approved, and you're ready to get the approval process rolling. The next questions to ask yourself is, how do I get from pre-approval to a closed loan? Jordan, can you tell us how to get from pre-approval to a closed loan?
Absolutely. All right, friends. So let's talk a little bit about this. The process will start with reviewing your loan options and filling out that loan application we talked about earlier. Loan officers will be beneficial here because they are professionals and can help determine the right loan product for you, whether you choose retail or wholesale lending. Let's look at the loan application itself. So the loan application is broken out into different sections containing information like type and term of the loan. This will be the loan product you are applying for, the loan amount requested, the amortization period, which just means how long do you have to pay it off, so 15 or 30 years, and the interest rate. Second piece of information on there will be your personal information. So that'll be your identifying information, including full name, date of birth, social security number, marital status, number of dependents, employment history, income, and address history. Section number 3 will be property information. On there, you will have your address and legal description of the property. It'll have things like the year built, whether the loan is for purchase, refinance, or new construction, and what the intended type of residency is, whether that's primary, secondary, or investment. Section number 4 will be asset and liability. That'll be a list of all checkings and savings accounts with your current balances, as well as life insurance, stocks, bonds, retirement savings, and mutual fund accounts, as well as all of their values. And section number 5 is declarations. This section shows any judgments, liens, past bankruptcies, or foreclosures, as well as any pending lawsuits and delinquent debts. You'll also be asked to state whether you're a U.S. citizen or permanent resident and whether you intend to use the home as your primary residence. The last section of the loan application contains demographic information. For residential mortgage lending, federal law requires that loan officers ask applicants for their demographic information, things like ethnicity, sex, and race, in order to ensure compliance with equal credit opportunity, fair housing, and home mortgage disclosure laws. Applicants are not required to provide this information, but are encouraged to do so. The law prohibits discrimination of credit applicants on the basis of this information or on whether you choose to provide it. Applicants may choose as many designations as they would like, or they can choose none at all. However, if you choose not to provide the information and you have made this application in person, so face-to-face with the loan officer, federal regulations require the loan originator to note your ethnicity, sex, and race solely on the basis of visual observation or surname. The purpose of collecting this information is to help ensure that all applicants are treated fairly and that the housing needs of the community are being fulfilled. Let's look at types of mortgages. Now, there are many types of mortgages that borrowers may apply for dependent upon their individual needs. Let's take a look at some terms to start. Fixed rate. So fixed rate mortgages have an interest rate that remains the same for the life of the loan. In other words, your total monthly payment of principal and interest remains the same over that time. Whatever interest rate you choose with your loan originator stays with your loan unless you choose to refinance in the future. An adjustable rate mortgage is a type of mortgage in which the interest rate varies throughout the life of the loan. With an adjustable rate mortgage, the initial interest rate you choose is fixed for a period of time. However, after that, the interest rate resets periodically based on market conditions. It can reset at yearly or even monthly intervals. And purchase loans are exactly what they sound like. You are getting the loan to purchase a home. That purchase loan can either have a fixed rate or an adjustable rate. We're also going to look at 2 other types of loans, FHA and conventional. Start with FHA. FHA loans have been helping people become homeowners since 1934. The Federal Housing Administration, or FHA, which is part of HUD, which is the Department of Housing and Urban Development, ensures the loan. That way your lender can offer you a better deal. The minimum FHA mortgage down payment is 3.5% for those who qualify financially. However, that low down payment option is not available for everyone. These loans are designed to assist borrowers in buying primary residences. FHA loans are for primary transactions only, and they allow for a lower credit score, as well as a higher debt to income ratio and a potential lower down payment. Conventional loans, on the other hand, are insured by Fannie Mae and Freddie Mac. They are federally backed home mortgage companies created by the United States Congress. Neither institution originates or services its own mortgages. Instead, what they do is they buy and guarantee mortgages that are issued by lenders. With conventional loans, typically a borrower will need a higher credit score and a lower debt to income. So with FHA, you can have a little more debt. With conventional, you have to have less debt. This is because conventional loans provide a lower down payment option than FHA for first-time home buyers. Conventional loans will allow a LTV up to 97% compared to an LTV of 96.5 on FHA. And if you're like, well, what is LTV? Cool. So before we go any further, let me break that down for you. LTV stands for loan to value. And that ratio tells you what percentage of the home you have on loan, or an easier way to say that is, what percentage of the home does the lender own, or is the lender still covering? So if you see an LTV of 97%, for example, on conventional, that means the lender is covering 97% of the home and you put down 3%. For the FHA example, the lender would have 96.5% of the home covered and you would need to put down 3.5%. So on an FHA, you can have more debt, you can generally have a lower credit score, but you do have to put down more. So in addition to that, traditionally conventional loans will have these stricter requirements because they offer that option to put less down. While lenders will have similar guidelines for FHA and conventional loans, the requirements aren't always identical, however. The most common difference you'll see is in credit score. For example, to qualify for an FHA loan, the borrower will need a minimum of 580 versus a minimum 620 for conventional. However, sometimes you will find that lenders have their own credit requirements called overlays, where you may need a 640, a 660, or even a 680. Another difference between the two loan types is mortgage insurance. So FHA loans require mortgage insurance to be paid for the entire term of the loan. Conventional loans only require mortgage insurance when your LTV is over 80%, and you can request it off once that LTV drops below 80%. If you're unfamiliar with mortgage insurance, it's money the borrower is paying to the lender that protects the lender against potential foreclosure or default. With all that being said, keep in mind the type of loan you will come with different requirements and guidelines, and always ask your loan originator which is best for you. The last loan type we're going to look at is VA loans. VA loans are mortgages that are guaranteed by the United States Department of Veteran Affairs. VA loans are available to active duty military members, veterans who have served, and surviving spouses. These loans are backed by the federal government, but still issued through lenders. Most VA loans do not require a down payment. And while the VA doesn't set a required minimum credit score, most lenders will want a credit score above 620. So how do you know if you qualify for a VA loan? Well, you meet one of these requirements. If you have served 181 days of active service during peacetime, if you served 90 consecutive days of active service during wartime, if you've served more than 6 years with the National Guard or Reserves, or if you've served 90 days under Title 32, with at least 30 of those days being consecutive, you could qualify for a VA loan. It is important to note that if you do qualify for a VA loan, they cannot be used for vacation or rental properties. Eligible borrowers can only use a VA loan to purchase a property as their primary residence or refinance an existing mortgage. With that, I'm going to turn it back over to Keisha.
Thank you, Jordan, so much. All right. So now that we know the different types of loans and programs that are out there, let's talk about how to move forward in the process once you've selected your loan type and the product. So we have what's called TRID. And TRID is a law that was put into place for the borrower to know exactly what's going on with their loan every single step of the way. The first important piece of information you're going to get is your loan estimate. This disclosure is one of 2 important disclosures you'll receive along with the credit application under TRID, or as many people call it, the know before you owe rule. TRID requires that credit applicants receive their actual loan estimate within 3 days of the actual loan application date. Again, the TRID requires the credit applicants to receive the loan estimate within 3 days of the actual loan application date. The loan estimate will detail the terms of your loan. The loan estimate also offers data that can help you compare loan offers from multiple lenders. And that's huge, okay? This is including total cost of third-party services, the annual percentage rates, your interest rate, including fees, and the amount of the interest rate you'll pay over the your loan term, as expressed as a percentage of your total loan amount. And once you've reviewed the loan estimate and you decide you want to move forward with that lender, you'll need to express that you want to move forward. And by doing that, it's called your intent to proceed. There are several ways that you can express the intent to proceed with the lender. If you can't go to the actual lender's office in person, you can communicate it over the phone. You can do it through email or by submitting a signed pre-printed form. Please forgive me. You can do it by submitting a signed pre-printed form. And that's for record keeping purposes. And the lender must document your intentions to proceed to officially move forward with your loan application. Another consent form you may receive with your loan estimate and intent to proceed is called an e-consent. This actually will allow the lenders to send you your TRID disclosures electronically. And we know in these days, most things are done electronically. And this will allow you to be able to e-sign the disclosures to acknowledge their receipt, okay? So again, you'll be able to electronically sign, and that's going to confirm that you actually received the documentation. However, you do have a choice. If you choose not to provide the consent to receive your documents electronically, all of the documents, they actually they'll have to be mailed to you, snail mail. So it's important to remember that if you choose to receive your documents by mail rather than by email, this could delay the buying process and you have to wait for the documents to be delivered, okay? And it's also important to note that you can rescind on the e-consent at any time. All right, so once the loan application is submitted and you've signed your intent to proceed, it's important to remember not to make any other big purchases until after you've closed on your mortgage loan. And we do understand that buying a house is a very exciting time. I know personally, you get a little anxious. A lot of people, they want to fill their homes with new furniture, new decor, or even get a new car. Some people may want to get a yacht to put in the driveway. I don't know, but you must know, just hold off. It's important that you hold off on making any new big purchases because it can actually mean additional hits on your credit report or charges on your bank account. And if you make any new purchases, you're actually required to disclose those purchases and you must qualify with those payment amounts. So again, please just hold off until you close on your loan to make any big purchases because ultimately, that could mean you don't qualify for the house any longer. So we want to set you up for success. Get excited, but just hold off. And I'm looking here and I was trying to think of some other big purchases, but I think the yacht, I think that was good. That was a good example there. Just again, hold off on the big purchases. All right, so once you've submitted your intent to proceed and the loan application, this starts the actual loan underwriting process. The mortgage underwriting is the process that a lender uses to determine if the risk of offering a mortgage loan to a particular borrower is acceptable. In assessing the risk, the lender will review the loan documents and loan terms and consider the 4 C's. What are the 4 C's? All right, let's go through them. So the first C, that's capacity to pay the loan back. Lenders look at your income, employment history, savings, and monthly debt payments, such as credit card charges and other financial obligations, to make sure that you have the means to take on a mortgage comfortably. Then we have the second C, which is the capital. Lenders consider your readily available money and savings, plus investments, properties, and other assets that you could sell fairly quickly for cash. Having these reserves, it actually proves that you can manage your money and have funds in addition to your income to pay the actual mortgage. Then another C, we have collateral. Lenders take into account the value of the property and other possessions that you're pledging as security against the loan. And the fourth C is credit. Lenders, they check your credit score and the history to assess your records of how you pay your bills and other debts on time. Even if you don't plan on buying a home now, it's always a great idea to build, and you want to maintain a strong credit. Why? Because landlords, they often check into how you make your payments. They want to make sure that you can pay your rent. So it's also important if you want to apply for a mortgage or other credit lines in the future, such as a student loan, car loan, or even more credit cards. So throughout the underwriting process, you may need to provide additional information. So it's important to remember that your approval is conditional upon the lender's review of all necessary documentation. So until they can review any and all documents, they cannot approve the loan. If the lender, they request for you to provide additional documents or even an explanation, you'll want to make sure that you provide the requested information promptly and accurately. Also, you want to make sure that all pages are included with your documents. And you want to make sure that you fully respond to any additional requests for clarification. And once you've provided the necessary information and the underwriter has reviewed and approved your loan application, guess what? You'll get a clear to close. So what does a clear to close actually mean? This means that you can now schedule your closing. Once you're clear to close, the closing agent will begin preparing the closing documents. And during this process, your closing fees, they're going to be finalized. Many of the title fees will be updated to reflect the final costs for recording fees, for notary fees, and for title company fees. And the signing date you choose can also impact the final cost. Your closing date will be used to determine the amount of prepaid items including in your closing costs and the amount you pay for your rate lock. A rate lock on a mortgage loan means that your interest rate, it will not change, okay? And you're given a certain amount of time to where you have to close on your loan, okay? So you're given an interest rate. You'll have a specified window in which you're going to sign your closing documents, you're going to be at the closing table, and you're going to have that same interest rate, but you have to close by that specific date. In the event that you're unable to close on that specific set date, you will run into the situation where that interest rate, it could potentially change. And that will be discussed with you, but the main goal is to get you closed on time. Okay. And if your rate changes, there's a possibility the interest rate could increase, and that could cost you more money to close. But again, the goal is to get you to close on time. Once the closing documents are prepared, your loan originator will actually coordinate with you to schedule your closing. The closing agent will review the documents one final time before conducting your actual closing. But remember, your loan has not closed yet. So you want to maintain a status quo and not do what? Not make those big purchases before you close. All right. So Jordan, can you take it from here?
Absolutely. So everyone, great news. Closing day is here. Up until the day of closing, you've probably only had interactions with your real estate agent, your loan originator, maybe the home inspector. At the closing table, however, you can expect your real estate agent will be there, the sellers, and probably their real estate agent as well. You will also have your closing agent who will oversee the closing, and you should have your mortgage originator attend. If that person can't be there, please ask them to be available by phone or video in case questions come up. So once everyone arrives, the closing agent will verify all borrowers on the loan and anyone whose name appears on the property's title. Everyone must sign all necessary documents and remember to bring a government-issued photo ID. The closing agent will walk all parties through the closing documents and identify where signatures and initials are required. Some documents will actually require a notary acknowledgement as well as the signatures. The notary is just a neutral third party who confirms the authenticity of those signatures. When buying a home, there's lots of paperwork involved, which means a lot of signatures. Even with all of the signatures involved, fortunately, closing won't take all day. Generally, the entire closing process will take about an hour. So at closing, you are also going to get copies of the documents that you signed for your own records. Those documents will include information on your loan servicing, such as your first payment date, the amount owed, and where to send your payments. You will also get a loan coupon book and a payment chart that will help you make payments and keep track of your loan. For most loans, the important thing is to make sure that the payment gets to the right place and on time. So please pay close attention to that first payment due date. But congratulations on your new home. Let's talk about what happens after closing though, so we don't get caught up in all that excitement. So now that your loan is closed, you will want to take a look at the future of your mortgage and your finances. You have your payment coupon book and your payment chart, which you might hear referred to as your amortization chart, but that just means your schedule of payments. You can also use payment options such as paying online, automatic withdrawal, or sending checks in. Just remember, whichever one you use, make sure your payments are on time. If there comes a point where you are unable to make your payments in full, please reach out to your loan servicer for payment options. Many mortgage servicers have programs to help people avoid foreclosure. Your mortgage servicer will look at your situation to consider the options that may be available to you. Some options that your servicer might make if you struggle to afford those payments are a refinance, a loan modification, work out a repayment plan, or forbearance if you're eligible. Now, tip here, sometimes your loan may be sold to a different owner or your loan might be transferred to a new mortgage servicer. If your mortgage is ever sold and you get a transfer notice, don't worry. It just means you have to make your same payments to a different servicer. If this happens, it's not a surprise. You will be provided with a notice. Under federal law, you're even given a 60-day period starting on that transfer date where you can still send your mortgage payments to your old servicer rather than the new servicer. During this time, there won't be a late fee and your payment won't be reported late to any of the credit bureaus as long as that old servicer receives your payment on or before that payment due date. So with that being said, I'm going to turn it back over to Sarah.
Awesome. Thanks, Jordan. So we're going to go over questions now, but I did want to say if you have specific questions pertaining to your situation that were not covered in today's presentation, please reach out to a lender or a mortgage broker of your choice. They will be able to assist you. There are lots of locally. Also, if you're interested in getting credit or budget counseling, there are several in your area. I've put a couple on the slide that you can see right here: Money Management International and In Affordable Housing. And so if you're interested in getting some assistance in that way, please reach out to them. They should be able to help you either free or in an affordable fashion. So I want to go ahead and move on to questions. We have a few really great questions today. So I'm going to start by answering the first one myself. So our first question is, are there any common contingencies to watch out for? So that's a really great question. So let's go back and just refresh our memories on what contingencies are. So contingencies are an unforeseen event or circumstance. So these would be listed in your purchase agreement, and your real estate agent would add them into your contract so that if an unforeseen event or circumstance takes place, you can get out of your contract to buy this home without any penalties. And so one of them would be financing. And so that would be if you are unable to secure financing for your loan. That's a really common contingency that a real estate agent will write into the contract. And that will allow you to get out of the purchase of the home without any penalty. There's also home sales. So if you own a home and you are not able to sell your home during that time frame, your real estate agent can write that into your contract so that you're able to get out of the purchase of the home if you cannot sell your existing home. Another really common contingency two really common contingencies that are put into a contract. I'm going to sort of explain these together because there's a lot of confusion between the two. So a lot of people confuse the appraisal and the home inspection. And so there's a difference between the two. And I'm going to, in explaining both of them, I want to say that they're both common contingencies that are written into a contract that will allow a borrower to get out of the contract if a home inspector finds issues with the home that the borrower or the seller is unwilling to repair, or B, the appraisal if the home does not appraise, which means that it does not, the value of the home is not what you think it will be or what it is estimated to be, then you can also get out of the purchase of the home for that reason as well. And the real estate agent can write that into the contract. And so the difference between an appraisal and an inspection is that a home inspector a home inspector determines the condition of a structure, whereas an appraiser determines the value of a property. The inspection is done for the home buyer, so they know the condition of the home. Some loan types require an inspection and some loan types don't. So an FHA loan, they do require an inspection. A conventional loan does not require an inspection, for example. The appraisal, on the other hand, is done for the lender so that they can confirm that the home is good collateral for the loan. So it basically means, you know, when they own 97% of the home and you own 3% of the loan, that your home is worth that 97% they're loaning you. So with that being said, essentially, if the borrower doesn't pay their loan, the lender can recoup those funds if they end up in foreclosure, and so that they can then resell it. You will most likely need both when buying your first home, and you'll most likely be paying for both the inspection and the appraisal. So the next question that we have after that is a question that asks about VA loans. For the 90-day VA loan, do you have to be in combat zone or just serving in the military? I'm going to go ahead and let Jordan take this one.
Sure. So first off, that's a great question. Thank you for asking. The easiest way to say that is a person who is active duty is considered full-time military. And if you are full-time military, it doesn't matter whether you're in combat or not, you would qualify for the VA loan. So being active duty kind of trumps all of that. So you would be good to go on that VA loan.
Great, thank you so much. And Keisha, can you answer any common pitfalls a first-time home buyer should be aware of?
Absolutely. Thank you, Sarah. So we want to prepare you for some things. Being a first-time home buyer, some mistakes that happen, but we want to, again, set you up for success. And we want you to avoid these pitfalls. The first one is not getting pre-approved. The way I look at a pre-approval is this is your checks and balances, okay? Even though that's not giving you that final approval, it's giving you the, yes, this is what you need, this versus this is what you have. This is what you will need to get. So it's there to get you prepared, okay? So try to steer clear of not getting pre-approved. Another thing is getting only one mortgage rate quote. It's always good to shop, okay? It's always good to get in the know of what's in the market, okay? So there's lots of tools out there, lots of resources. Start researching just to see what rates are out there for the consumer. So do that part of it, do the legwork. That way, when you start communicating with a real estate agent, when you start communicating with lenders, you will at least have the basis of what's available to you. Okay, so there's nothing wrong with getting more than one rate quote because you want to get what's more comfortable for you, what works best for you and your household. Okay, not working with the real estate agent. We highly encourage you to have a professional with you. Okay, especially being a first-time home buyer. There's questions that you may not even know that you need to ask. So if you have this professional with you, side by side with you, they'll be able to guide you, to be able to give you the do's and don'ts, or maybe what you can do versus what you can't do. They'll be able to supply you with other options. They'll be able to think of those questions that you may not know that you need to ask. Okay. Another is buying a home that you can afford, or should I say buying a home that is more than you can afford. There's nothing wrong with having big taste. You want this big, beautiful, elaborate home. There's nothing wrong with that. Just make sure that it's something that is affordable for you. Because when you're in your home, you want to be able to live comfortable. You know, you want to be able to make your mortgage payments on time, pay utilities, have great food. You know, you want to be able to still live. So it's important to get a home that you can afford. We don't want you to get in there and think, why did I get this home? I knew I couldn't afford it. All right. Then not checking your credit report. No one likes surprises. Before you have anyone pull your credit, no, this is a no before you owe. You want to know what you're getting yourself into. Know your numbers. Okay, that way you can go in with your information, with accurate information. So when someone comes to you to tell you that they pulled the credit report, they give you your numbers, they tell you what you qualified for, then you won't be surprised. You know, because you may, if you don't check your credit score, if you don't stay on top of that, you may think that you can get qualified for something that's more than what you're qualified for. And you don't want that to happen. Okay, so know before you owe. Waiving a home inspection. It's important to know what you're getting yourself into. Okay, you want an inspection to be done. You want to know what the details of that home is. You want to know what's in the home, what's outside the home. So avoid not having an inspection. Okay. One big one, please avoid spending all of your savings. It's so easy to wine and dine yourself. I know this, but buying a home is a huge life-changing experience. You want to have savings. Do not spend all of your money. You want to have a nice savings, a nice cushion, because as I stated earlier, you want to be able to save at least 3 months of your monthly mortgage payments. You know, you want to have that cushion. So when unexpected expenses happen, car breaks down, medical expenses, whatever the situation, life situation that may come up, you want to be able to take care of that. And you want to be able to still make your mortgage payments. So again, avoid spending all of your savings. And in turn, not saving up enough money. That's just as hurtful or dangerous for you. You want to make sure that each time you get paid, just a personal experience here, each time you get paid, take out a certain percentage, put it up. Or if you get direct deposit, save that in your other account. You want to make sure that you're setting yourself up for success. You want to make sure that you have money available for your earnest money deposit. You want to have money available if you need it for closing, you know, if you're closing, when you're at the closing table. So do your best to save, save, save. Okay. And the last point is not getting an inspection. As I stated earlier, you want to know what this home is about. That's the best way I can put it. You want to know, you have to know, because you don't want to get yourself in a situation in this home and say you're in there for 30 days and the roof collapsed. You didn't look at it. No one looked at it. Look over the home. Have the inspections done. This is to protect yourself. Think about how long you're going to be in this home. Think about this big life change that you've committed to, and you want to make sure that you are successful and that you are able to be happy with this home, because you don't want to sign your name on something and you're not happy with it as soon as you get into it. Thank you.
So I had one more thing that I wanted to add to that, and it sounds like Jordan does too. And I wanted to add that it's also really important to look into down payment assistance programs and different options to there are a lot of programs out there for borrowers who are low or very low income that can get assistance for, you know, a certain percentage off of your down payment or closing costs. So working with those nonprofit organizations at the bottom can really help get you some really great information and knowledge. Also, when you start working with a loan officer, ask them what's out there for you. When you talk to, you know, anybody, those working with real estate professionals, whether it's a nonprofit, whether it's a lender, whether it's a mortgage broker, getting in there and asking them what options there are is so important, because I think more than anything, it's important to know that they're lucky to have you as a borrower. So go in there, asking them all the questions, finding out what's available for you. It really does make a huge difference. Awesome. All right. Well, we are going to give the rest of your evening back. So thank you for joining us and have a great rest of your day.